So, do you have a strategy that makes you profitable in the stock market? Are you able to even break even in the stock market? Do you know how to trade? What indicators are you using on your charts that make you profitable at the end of the day? I am not a trader that uses indicators. I've been doing this for 30 years. And I do not use indicators to trade. So I use price action, I use trend lines, I use support and resistance and that sort of thing to do my trading. But today I am going to show you the moving average crossover system just so that you know how it works. Just so that you understand how the other systems in the market work. Now, last week I brought out a video about the fair value gap, which we can use in our trading. Now, this week I'm bringing out the moving average strategy because you can use it, for example, in investing. I do tend to use it in the investing world because in investing, it's actually quite a useful product. But for trading, it's a lagging indicator. And what I actually want to show you with the moving average system is how it actually can be a bit of a loss for you more than a win, that it actually can work, but it doesn't work that well. And I have tested it out before. I have used it before. I'm not going to go through the whole back testing thing here. I'm just like pointing out to you that this is not an indicator that's going to, or a system that's going to make you hugely profitable in the market. It can work for you. It's not a system that doesn't work, but just so that you can see what's happening there, because there'll be a lot of people out there trying to tell you that this is the system that's going to make you money. This is how you're going to make money in the market. The only way you can make money in the market is by understanding that trading is a 50-50 game, is by understanding that it's not about a system, it's not about a candle, it's not about a moving average. It's about how you approach your trading. It's about how you manage your losses, how you manage your risk is how you make the profit at the end of the day. It's about losing less on your losses and making more on your wins. That's how we make money in the stock market. So before we go to the charts, before we go and have a look at all this, just bear in mind that trading is risky. Trading is a risky game. 80% of traders do lose money. And if you don't like losing money and you don't like risk, you probably shouldn't be trading. After we've been to the charts, we'll go and have a look at the free gift. We'll go and have a look at the trade of the day, and we'll talk about one or two other things. For example, fear, managing your loss, and how to be profitable in the stock market. But before we do that, let's go and have a look at the charts. Let's go and see how you can trade with a moving average. I'm going to show you a simple moving average strategy. This is the exponential moving average. It smooths it out. You can use a simple moving average. Doesn't really matter. Now, you know we only trade with support and resistance or trends, and we don't use any indicators. But I'm showing you this just so that you can understand what it's all about, because many will have told you you can make money out of this. And I'm just going to show you why you can and maybe cannot make money out of using the simple moving average strategy or exponential moving average strategy. At the end of the day, I just want to show you how the strategy works and why the strategy exists. Now, this is a strategy that I would use if I was investing in the stock market only on the 50 and the 200-day moving averages. But on trading, what traders actually do is they use a 9-day, some 10 days, but I prefer a 9-day moving average, which is the blue line, and a 20-day moving average, which is the purple line. Some traders will add a 50-day and a 100-day on top of this as well, so you can see when they squeeze together and they squeeze out, and it just gives you an indication as to when trading is occurring. What I look at with a simple moving average strategy, or a moving average strategy, why do I keep saying simple? You can use the EMA as well. These are EMAs, by the way. It's smoothed out. But what you do is you wait for the 9-day to cross the 20-day, giving you that sort of golden cross. And when it crosses there, then you take your long trade. Now, you may think this is great. This is easy. Look how easy this is. But just look at my chart here. You would have had to take the trade in this area here, which probably would have been fair. Then it goes up. And then you get out of the trade when it crosses back through. That's the deal. So that's how it works. You get in the trade when it crosses up. You get out of the trade when it crosses crosses down. Now you may look at that and think, well, look there and there's the profit. But actually just look at where you would have got out. You would have got out down here. You would have got in over here and you would have got out down there. Where's the profit? There's no profit in that trade at all. Okay, so let's have a look at the short trade, which is a bit more vigorous. It's a bit longer. That looks a bit better. Okay, so you take the short trade when it gets in here. So you would have taken that trade, let's say somewhere around this candle here. So there's your trade. You take the short and it goes all the way down, which is fantastic. Then it starts going long again. So you're going to get out of the trade somewhere around here. Your profit on this trade is between there and there. So 1044 and let's say 1074. So about 30 points. Now, had you gone short on price action, you probably would have gone short on this candle somewhere there and you would have got out somewhere down here. So your profit level would have been between say 110.30 and 110. So, you know, you would have made a lot more profit just by trading on the price action. This is what I'm trying to show you here. Here's a nice trade. Okay, so here you get in long at this level. And it travels all the way to the top on the price action, which doesn't always happen. You might have wanted to get out here because you saw it coming down, but it didn't cross, so you stayed in. So you'd be still in this trade. So this would have been a fairly good trade. So that's basically 1 out of 3 that would have been pretty successful. So it's not an unsuccessful trading system. It's just a very, how can I put this to you? The indicators are lagging. So it's a lagging indicator system, which doesn't allow you to make money in an easy way. So if you go to the FTSE here, now here's a classic example of a trade that's just, you know, if you'd gone long into this trade here or gone long into the trade here, right? So you would have gone long somewhere around this level. And you've been in this trade for quite a long time. This is quite a while. The price has crossed back through the moving average. That can also be a problem. And it goes back up and it's all the way up here. And the moving average hasn't even crossed back down yet. But your price is almost at your cost already. Look at this. Look at where the price is reaching and where your cost is. I mean, you're pretty much coming back down to cost here. You're not getting anywhere with this trade. You're not getting a profit. And in fact, it's going to go into loss before you get your money out with this moving average crossover trade. So that's how most people trade with a moving average crossover. Let's have a look at the US 500. This would have been a really nice trade. The moving average crossover works pretty well when you get long runs, when you get decent runs on a trade, but so does price action. So, I mean, what difference does it make? Let's have a look at the DAX. Very similar scenario where it crosses over here and you know, by the time it crosses back, you're almost back where you started. So this is a nice long run. You would have made a profit on the DAX over there. Look at gold. Gold is got a nice long run on it. So that would have taken you quite a decent distance as well. If you want to trade with the moving average crossovers, you can. It's not a failure, let's say, but all I say to you guys is be careful when you're trading on these lagging indicator systems. You can use the MACD as well. The MACD works on a very similar scenario. I'll show you that in another video. But what I actually use this moving average crossover for is, for example, let's take NVIDIA, which is a great investment. Now, these are my investment trades. And then what I'll do on an investment trade, it'll be on the day because I trade on the day when it comes to investments. On investments, I will take the 9-day and I'll turn it into who can tell me, a 50-day, guys, a 50-day. So the input on the 9-day becomes a 50-day moving average. That's my 50-day moving average now. And then the purple one, which was a 20-day, that now will become 200-day moving average. And what I'm looking for there is that it's above the 200-day moving average. And as long as it's above the 200-day moving average, there's my golden cross. See, it came across there. That's where you want to be in the trade. So all that this tells me, all these moving averages are telling me, and they're nice and far apart as well. What they're telling me is this is an absolutely fantastic investment and I can keep taking long trades in it. I can keep adding to my investment. But most of my investments are set and forget anyway. What it does for me though is it tells me on a product if the 50-day is below the 200-day, it just tells me, look, don't trade, don't buy. So that's all it tells me. See, like here where the 50-day was below, that was not a buy. That was a death cross. So you would have wanted to actually sell out of that and put the money into something else maybe. But if you were confident and you set and forget and you leave it, there's your golden cross again. She's back above the level and you can keep on buying Tesla. Nothing wrong with this product because the 50-day is above the 200-day. So that's how I work with the moving average crossover system. That's the only time I'll use it is on investments. If you do want to use it for trading, then go ahead, no problem there. Go mad, use it. But like I say, don't get overexcited about it and don't think, oh, this is going to work for me, because believe me, I've tried all these different systems and they're quite difficult to operate with. So now that you know how to trade with a moving average, will you use it? Won't you use it? Let me know in the comments, guys. Let me know what you think of the moving average crossover system. The moving average crossover system is very, very similar to the MACD. For example, it works on a very similar basis. Most of these systems do. But the problem that you have with a moving average crossover system, as I say, is it's always a lagging indicator. It always is a little bit behind the curve. And there's a very good chance that when you take your trade, that when you get out of your trade, you're not going to make any profit unless it's a really good run. Whereas price action gives you a lot more room to make profit. It gives you a lot more space to make the profit in. You can take the trade at the bottom and get out at the top. You can actually manage your risk a hell of a lot better with support and resistance, supply and demand, and those types of systems, because you can work out your stop loss a lot easier. And as I said to you, let's work out how you can manage your risk in such a way that you can actually make a profit. Now, the thing here, guys, is for you to understand that it's all in the mind, that it's all in the psychology. Two traders can have exactly the same system. One will lose, one will win. And it's simply because of the way that that trader approaches the system, approaches the way they make money in the stock market. Because the understanding you've got to have is that when you take a trade, there is a 50% chance that you could win, and there is a 50% chance that you could lose, no matter what your edge, no matter how good your system is. Your system might win you 8 trades out of 10, but you as a trader might be a 50-50 trader when it comes to profit. So now the whole idea behind this is simple, and that is to lose less on your losses and make more on your wins. How do you do that? How do you actually do that? Well, simply put, no matter if you've got favorites that you trade and you want to trade more in them, or that you've got ones that you don't normally trade on a daily basis and you want to trade less on them, you don't do that. What you do is you work out what your risk factor is. So for example, if you've got a $25,000 account, you say, I want to take a 1% risk on every trade. Then what you do is you risk 1%. You risk $250 on every single trade, no matter what. Doesn't matter if the stars have aligned on the left, if the stars have aligned on the right, or if the world is ending. You risk $250 on every single trade. Now, how do I manage the size of my trade? How do I put my stop loss in place with that in mind? Well, the first thing you do when you're taking a trade, if you decide you're taking a trade on the FTSE today, or the Euro US dollar, whatever the case, what you do is you work out where your stop loss is going to be. So the price is here. I want my stop loss over here. How many points away is that, right? Now you've worked out the size of the stop loss. Now you convert that stop loss size into dollars or pounds or rands or whatever you want to convert it into. If you're trading in dollars, you convert it into dollars and you say, how much is that as $250? You work it into $250 and that's the size of the trade you're taking. So if it's 0.15 of a contract, then so be it. That's the size of your trade. Then you put your profit in place and worry about the profit, because the profit will come later. What you want to do is make sure you've got a good risk to reward ratio. So for example, you're risking $250. You want to be making $500 or $450 or $400 or $600 or even $1,000. You don't want to be making $100 on a $250 risk, because then the risk to reward just doesn't make sense. You're winning less than you're winning, you're actually losing. So there's no point in that. You want to make sure that your reward side is higher than your loss side always. Now you've got a trade in place. Now you've got a good risk to reward because you've worked out what your risk is. Now you just need to work out what your profit will be. And if your profit will give you a reasonable return, that's a good trade. Take the trade. When the trade goes into profit to the value of $250, then you move your stop loss up to cost, break even, and then you keep following the trade. And as the trade goes, you keep moving your stop loss up. There'll come a point when you're a good trader, when you decide when you want to get out of a trade, when you want to sell out of a trade, because you feel that that trade's run long enough. Other than that, you can keep following the trade up with your stop loss, and you you can add to the trade when it's winning. Don't add to the trade when it's losing. Here's two things you don't want to do. Two things you do not want to do. Number one, you do not want to move your stop loss down when it's losing. So it's coming down, it's coming down, it's coming to your stop loss. Oh no, I don't want to get out of the trade, and I'll move the stop loss away. You've just changed your game. You've just changed your business into a losing business, because now you're going to take a loss on that trade, which is more than you were, more than your business plan had put forward to you. You've got a business plan. Your business plan, whether you've written it down or not, your business plan is to lose $250 on a trade. That's it. Now you're making it $400. You've just changed your business plan. That's going to cost you. That's going to cost you big money. Now you're thinking, I'm going to hedge this down. I'm going to add more to the trade. So we're going to make it even worse. And then we're going to make the loss $800 because we've doubled the trade, because we want to hedge and we think it's going to go back up and it'll get us out at cost. But then it doesn't. It gets worse. It gets worse. So now it becomes $1,000, $2,000 loss, which was supposed to be a $250 loss. How do you justify that? You're never going to get that back. Don't do that. Don't add to the trades going down. Don't move the stop loss down. Don't try hedging out of the trades, because you know when you get out of the trade, you're going to get out at break even anyway. You're probably going to get out at a tiny little profit or break even and say, ooh, I'm a profitable trader. I win more trades than I lose. My system wins 8 times out of 10. But the 8 times that I win, I'll make $10, and for the 2 times that I lose $1,000. So I'm actually $2,000 down. Yeah, no, that just doesn't make sense, guys. It doesn't work like that. So that's what you got to get your head around. You got to get your head around that this is 50-50. You got to get around your head around that it's your psychology, your mind, and how you approach it that's going to make you the money. It's a business. Put a business plan down, stick to it, and work according to that. I don't say you have to be stringent on the rules, because I'm the first one that breaks rules. But what I do say to you is work it as a business. Don't look at candles as candles. Look at it as people trading behind the market. You have to understand that there's buyers and there's sellers in the stock market. Both of them want to win. Both of them believe they've got the best system in the world. Both of them believe they're going to win. How do you think you're going to have a 70% win rate against a pro who believes he's going to win and he's got a 70 or 80% win rate? I've seen guys out there with a 20% win rate be more profitable than most guys I've seen out there with a 70% win rate. So don't think that a win rate is the thing to look at. The thing to look at is the profitability rate. Can you be profitable in the stock market? Can you become profitable in the stock market? And are you able to make money at this as a business? Guys, don't forget to go and get your free Forex book in the description that I've got there for you. It's a PDF. It's all about trends, and it'll kind of help you along the way with your trading systems. And also, I've got Trade of the Day. Every single day I bring a Trade of the Day out for you. I normally list it on the community and I put it in a little blog. It's just a trading idea. It's not trading advice. It's just there so that you can go and check how your trades are doing and if it works against yours or whatever the case. I've also got the members area. If you want to join the members area, I give a little extra video every day about Trade of the Day. I have all the little extras there, and there's a list of trades about, that's going on for that day and that sort of thing. So if you want to get a little bit more involved, you can join in the members area and be part of this community in a much bigger way than you already are. But this is a community that we're growing here so that we can make you all into profitable traders, man, so you can all become profitable traders. Come back for the live video tomorrow. Tomorrow's the European session. It's on a Tuesday, and Thursdays we have the live video on the US session. A little bit of fun. It's always fun to have a bit of a live video. And then we've got Wednesday's normal video as well. Guys, I thank you for watching. Don't forget to watch the last videos, and we'll till next time. Cheers, and I hope to see you tomorrow, the live video. Thanks. Bye.